We are excited to host another out-of-the-box video on demand. This meeting will include a brief presentation from two of our financial advisors, both who are members of the investment committee. They will present thoughtful insights about the markets and the economy. This is in addition to the quarterly newsletter that is sent to you and available on our website. I now introduce to you Doug Box and Cyrus Shabaz.
Well, welcome, and thank you so much for joining us for another episode of Out of the Box on Demand. We are so excited that you're here. Again, where we as a firm want to really give you some more insights as to what our investment committee is really thinking about as we are so diligently trying to manage your portfolio in this uncertain world. And with me today, as always, again, I've got Cyrus Shabaz, another member of our investment committee. Cyrus, thank you so much for joining us today.
You're welcome. Thank you.
Yeah, absolutely. And I know that you've been a little bit sad the last couple months. And I have a feeling a little bit of it was because Austin had to go back to college. And you got that taste over the summertime of what it was like to be able to hang out with him at work. It was
a lot of fun, but he needs to get back and finish.
Yes, he does need to finish because we want him full-time here. And I think he's just got 2 more years left?
2 more years.
Okay, so we'll wait and we'll be patient because he is spectacular. And today we're going to be, again, discussing what type of things have really had the biggest impact on the portfolios over the last quarter. We're going to be, again, also thinking about and talking a little bit about what things are currently affecting the portfolio in this environment. And then, of course, we're going to be trying to tackle over the next, again, few months, what things might have the greatest impact as we, again, work our way through. In addition to that, we also have a question. One of the most popular questions that's been coming in from you wonderful people like you is the question around the national debt. And the question is all about, is the U.S. national debt on an unsustainable path? And on top of that, why is nobody talking about it? Which I think is a great, again, almost like 2-part question that we're going to try tackling at the conclusion of today. Now, before we actually get to all the meat of the matter, I do want to, again, bring you one quick update to the firm. And actually, it's actually around the office space here. As most of you know, that we had a theme for when we built out this office 2 years ago. And that theme was a rewind into the future. And so our whole goal here at Box Financial Advisors with this space was that we wanted to take all the best aspects of the past and bring them forward with us as we move forward into the future, using all the great technology that we have as we move forward, but also blending it with some of the great old things. And so one of the things that we did have in our trading room is we have got this great cutting edge LED ticker tape display so that everybody can keep a very constant pace of what's going on in the marketplace. But with that, we also wanted to have one of these antique ticker tape machines as well from the late 1800s. That was the rewind portion of the decor. We unfortunately ran out of budget 2 years ago. And again, we are financial advisors, so we do have a strict budget and we do adhere to it. Of course, because we're good stewards, we decided, you know what, it's not happening today, but then we diligently saved for it over the last couple of years. And we finally were able to successfully acquire one and now put it in the trading room. So again, anytime you come down here, downtown Minneapolis, again, ask and we will be more than happy to allow you to, again, take a peek at the old ticker tape machine. It's really cool.
What a unique piece.
It really is. All right, so Cyrus, we are on to our first question. So help me, Cyrus, what were the biggest factors that affected the portfolio over the last quarter?
Well, in September, I think the biggest news was that the Federal Reserve lowered interest rates by 50%.
Yeah, I was kind of surprised everybody. I thought, a lot of people were talking about a 25 basis point cut, and they did twice that.
Yeah.
So.
This signal to us is that the Fed is seeing their 2% target on track. Mm-hmm. Number 2 is, even despite the recessionary fears and elevated rates, the S&P 500 still eked out 5.5% growth over the last quarter.
Wow, that's very amazing.
And now we're into earnings season. This is where corporate America shows us what they performed in third quarter. And we're expecting a strong quarterly earnings growth rate of 4.2%.
Oh, wow. I mean, again, it's really been impressive to see, even with the elevated interest rates, how well corporate profits have been.
And the consumer.
Strong. And the consumer has been so strong. All right, Cyrus, well, that's great. But again, what is happening now?
Oh, the unemployment rate has increased to 4.2% in September.
Okay.
Now, keep in mind is that this time last year, we were at 3.7%.
Okay.
Okay.
That's still not too bad.
Obviously it's not. It's still well below the long-term average of 6.2%.
Okay.
Number two is the August CPI number, month over month, was up 0.2% and 2.59% year over year.
Okay. Again, not too bad.
Not too bad.
Close. It's got a 2 in front of it at least.
Yes. The PPI number, which is the producer price index, wholesale type of inflation, that's been up 1.76% year over year. So again, targeting right towards what the Federal Reserve is looking for.
Right. And the PPI is, again, that precursor, right? Because it's the wholesale prices.
Yep.
Okay. Yeah.
And finally, retail sales. Retail sales was up 0.1% month over month.
Okay.
In August, it was 2.1% year over year. This signal to us is that consumer is still spending and not retrenching. Okay, and even that is despite even higher interest rates, higher prices, and a softer labor market.
Yeah. No, that's incredible. I was also reading too that their credit card debt, which was one of the things that we were kind of starting to be a little bit concerned about because it was starting to ramp up, has actually started to kind of plateau. That even while the consumer is having very strong spending, they're at least now not putting it quite so much on their credit card and are just paying cash for it. So again, that's great to see.
That is great to see. Some great quality characteristics for our consumers.
All right, now Cyrus, as we pull out the crystal ball. This is always my favorite part, to see what kind of things you were thinking about in the future. We pull out the crystal ball. What possibly might be in the next few months for us?
Well, Fed Chair Jay Powell has not wavered in holding a restrictive policy until we have good, solid inflation readings.
Okay.
As a result of that, they are now feeling that inflation is tracking towards their 2% number. In the Fed's eyes, a slowing labor market is a bigger risk to inflation. So we see plans for further rate cuts, but these rate cuts are going to be stimulus to support economic growth. So we see another 25 to 50 basis points by year end, bringing Fed funds rate to 4.5%.
Okay.
Number two, the stock and bond market are going to be looking at two different things. The bond market is going to be focused on inflation. They've always been focused on inflation because higher inflation, that means you're getting erosion of your bond yields.
Right.
And as we start to see those cuts, we could actually start to see appreciation in those bonds. Unlike those other bad years of 2022,
Right.
in which we had losses even in our bond holdings. With the stock market, they're looking for future rate cuts. Because these future rate cuts acts as a stimulus, hoping then that we have even higher earnings. So that's going to, in a nutshell, what those two are looking at.
Yeah.
But my last point is even more important. The stock market is up 21% on a year-to-date basis, and we're only through 3/4 of the year. We've still got one more quarter left.
It's been surprisingly strong.
It has been. And many of these metrics that we are using do point to frothiness in the stock market. Whether you're looking at PE ratios, you're looking at S&P earnings yields, you're looking at Morningstar fair value, they're all pointing to frothiness. Okay? And with the November elections coming around the corner, it would be unusual to see some extra volatility.
Okay.
But I say this again, the strength of the U.S. economy is very strong. We have a lot of positive forward momentum, so I wouldn't really bet against us.
Yeah, right. And again, even around the volatility potential around the election, it could probably be very, very short term, like it usually is, if there's going to be any whatsoever. And then as soon as the election is done and gone,
And on top of that, think of the future rate cuts we're going to have in 2025. Remember, in the first quarter of this year, we were expecting 6.
Right.
And what happened in the first quarter? The S&P 500 grew by over 11% in the first quarter alone.
Right.
So with those expected rate cuts, we could possibly see some stronger momentum.
Yeah, well, that's fantastic. And at the same time, though, I do want to point out that you did mention frothiness. So that means the valuations are not inexpensive. So people are, again, the valuations are relatively high. And that's, I think, the thing that always keeps us in with a little bit of caution to make sure that we're not, again, buying prices that are just too high. So.
Doug, what are some of the high points of success for our models that you want to share?
Oh, I'm glad that you asked. And again, this has actually been just a fantastic year for us. The couple things that I will mention is, number one is our conservative positioning. So in this particular year, there was so much uncertainty as we kind of working our way through this year that we have had the lowest level of stock positioning in our portfolio, in most, especially the conservative portfolios that we've had in 20 years. And with the combination between, again, high level of uncertainty along with a very, very high level of dividend yields that we were getting paid on these bonds, it, again, just made sense to us to really take some risk off the table. And as a result, we have made very, very nice returns. And that's been one of the common themes as we've been having meetings, is just how surprised people are with the rate of return that we've had this year in their portfolios, given how low the risk has been. And honestly, again, it's been the lowest ever since we've been, you and I have been working together for 22 years. And that's been very, very nice. The second thing is around hard assets, adding hard assets. So we started adding hard assets into the portfolio, some of the portfolios in May of 2023. Hard assets can, again, depending upon the type of portfolio, can include anything from gold to things like natural resources and commodities. And why do you buy these things? You buy these things when you think that the dollar is going to start softening. And we've just been in a really long period of time with it. We had a very, very strong dollar. Now, we do think that again, moment is going to be subsiding, and we're going to be having to deal with a little bit softer dollar in the months and years to come. And that's why we started to pick up some of these hard assets. Just again, slow positioning as we just take a peek and just make sure that everything is trending truly in that direction before we add any more. But that would be our second, I would say.
That has benefited our portfolio's returns.
Absolutely.
All right, Doug. Question: is the U.S. national debt on an unsustainable path, and why won't anybody talk about it?
This is a great question, and it is one of probably the most common questions that I'm getting these days is all around the national debt. And I think the short answer is that we would suggest that we are on an unsustainable path. Our debt is growing quite fast, but to arrive at that conclusion, we have to usually we look at it in comparison to something, and we generally look at it as a percentage of what the GDP is for the country. It's just kind of like, again, your debt to income ratio. A debt can be a big number, but a lot of it depends upon how much income are you making. If you have $100,000 of debt and you only make $10,000 a year, that's a lot of debt. If you have $100,000 of debt and you make $1 million a year, that's not a lot of debt. And so that's what this debt to GDP ratio allows us to look at. And currently it's at around 100%. Now, again, as you look at the context of history, we would say 100% right now is relatively high. The last time it was around 100% was actually all the way back to 1945, World War II, and all of everything that had to go into that war is what caused the debt to GDP ratio to actually jam all the way up to 119%. So it's very high. It really skyrocketed. Now, what's interesting is that level continued to fall all the way into the mid 70s and hit a low rate of 24%. So, I mean, it was incredibly low back in the 70s when they have really, really high interest. One of the challenges I think that we have is that the debt really started rocketing after COVID. Now, prior to COVID, the debt to GDP ratio was 79%. Then with all the spending that happened during COVID, again, that's where we get to our almost 100%. The challenge here is what the path that we are projecting forward. Not we, but again, the tax office is basically projecting it themselves. And some of it will depend upon whether or not the Tax Cut and Jobs Act that is set to sunset at the end of 2025, if it actually sunsets or not. But regardless, the debt to GDP ratio just continues to be projected to grow quite high. So if that Tax Cut and Job Act, which actually again raises less revenue for the government, if that does not pass, and again we go back to everything that it was 10 years ago, then our debt to GDP ratio is projected to be in 2034 at around 120%. But if we do basically pass it and allow it to continue for the next 10 years, then it's going to be projected to be 131%. Both are, we would say, very, very too high. And we would like to think that something is going to happen to be able to get our politicians to have their eye on this ball before it gets too large. Just to put things into context, again, right now our deficit, 100% of GDP, is $35 trillion, which is an enormous number.
$35 trillion in context is 35,000 U.S. bank stadiums.
35, because these were $1 billion apiece, $1 billion. So putting up a U.S. bank stadium pretty much all over the country, every little city, every state, every little city. That's a ton.
That's $100,000 on every person living in America.
Right, including the newborns, right?
Everybody.
Yeah, and it is just such an enormous amount. And I think the challenge is that how do we work our way through that? Again, also, one of the biggest challenges is the interest. The interest right now is at around $900 billion of just interest on this debt. That's the same budget that we have for defense. So, I mean, it is just such a huge number, and it's projected by 2034 to actually be larger than $1.5 trillion a year in just debt or interest payments. And so, again, at some point, something's got to happen. I think one of the challenges that the politicians have is it's not a popular thing to talk about, really, because there's only truly 3 ways that they can take care of and help resolve some of this debt. And 2 of the ways are just not popular with getting reelected. The one way is that you cut spending. It's a very commonsensical way of reducing your debt is you just stop spending so much. The problem is that it's hard to get a politician to really get excited about cutting a lot of spending because they know that their chances of getting reelected are harder. And so it's hard for, even in the little tweaks that they make to cut, to make a dent in this kind of a debt. The second way is through raising taxes. And again, same kind of scenario is that it's really hard to raise taxes enough to make a dent in this and yet still get reelected because, again, these guys are going to be extremely unpopular after they would reduce or increase those taxes so substantially. And then the third way is by monetizing your debt. Now, again, this is probably the way that is easiest for a politician to get reelected on, because what monetizing your debt basically means is that they have the Federal Reserve just print a bunch of money, and the Treasury just issue more debt. And so, again, what that does, it is why the dollar starts to soften. And honestly, why we believe that the dollar may be on a softening trend, because we don't know that there's enough politicians that are going to have the ability to reduce spending, increase taxes. And as far as we can calculate, there's only one other way to deal with this, which is printing money. And so with that is one of the reasons why we do think that the dollar kind of does soften. Nothing to be too terribly concerned about, nothing crazy, but again, a softening trend is one that is most likely, and why we are getting more and more interested in hard assets as we move forward. So again, we'll see. I don't know. It's just not a popular, and I have been really, really surprised that it's not come up in really the debates. It's not come up in really anything. Nobody's talking about it. And at this particular moment in time, neither candidate has any interest in reducing the deficit. Both of them, no matter who wins, their plan is to let the deficit keep running.
Maybe they're holding a winning lottery ticket and haven't told us yet.
Yeah, maybe. I have no idea. But the national debt is, again, on a path, and it's not real healthy. And I'm not sure what the exact solution
Well, at
will
least
be.
we're talking about it.
Yeah, we are talking about it. Hopefully, again, more and more people will talk about it because, at that level of 35 trillion, that's $100,000 a person, like you said. At some point, again, I don't know who's going to pay for that. That's a ton of money. In wrapping everything up here, we just want to thank you so much for joining us today. We thank you for the trust and confidence that you've placed in us and our firm in managing your wealth. We really, again, do truly appreciate it. Thank you also, Cyrus, for joining us today. Again, it's always a good time. So until next time, take care.
Thank you.
Bye-bye.